If you sit by the river and watch, one day the corpse of Bitcoin will float in front of you. This is a direct quote, and it comes from Pan Gongsheng, the recently appointed head of the People's Bank of China. It's safe to say that it foreshadows some changes in China's recent crypto stance. And it's not just crypto either. Pan's appointment comes at a time when the Chinese economy is struggling, the Chinese yuan is collapsing, and China's relations with the US are rapidly deteriorating. So today, we're going to tell you everything you need to know about how China could impact crypto, macro, and geopolitics in the coming months. Make no mistake, this is a video you need to see. Let's start with a bit of background. You can think of this video as being an unofficial part 2 to our video from earlier this year about China's reopening. To bring you up to speed, investors were expecting the Chinese economy to boom after pandemic restrictions were dropped late last year. This never happened. Instead, we started to see statistic after statistic suggesting that the Chinese economy was slowing down fast, mainly through figures related to manufacturing. Now, this wasn't too surprising given that China's economy is reliant on the consumption of goods in the West, and Westerners have been heavily buying services instead. It was only surprising to those who believed that Chinese consumers would make up the shortfall. This was somewhat logical given that the country had just exited almost 3 years of lockdown. There was an expectation that there would be lots of spending in China in much the same way as we saw in the West. The key difference is that China didn't provide direct stimulus to its citizens the same way Western countries did. China has also been cracking down on its housing market, the only asset class that Chinese citizens felt comfortable investing heavily in. Lo and behold, they haven't been big buyers lately. As a result, the speculative rally in Chinese stocks was quickly brought to a halt. As you can see, Chinese stocks had been rallying since last October and hit a local top in February. Since that time, they've been in a strong downtrend and even appear to be painting a nasty head and shoulders pattern. Now, in theory, a weaker than expected economic recovery in China should have also resulted in a correction for stocks in the US and elsewhere. This is because the narrative was that China's economic recovery would be epic and it would somehow result in lots of consumption that would increase profits. In reality, however, stocks in the US and elsewhere continued to rally. This was, of course, mainly due to other factors such as a rise in liquidity because of the de facto bank bailouts in March and the AI boom. However, it was also due to the perception that the Chinese central bank would start to stimulate. In other words, bad news was still good news because investors immediately pivoted to expecting that China would respond to its economic weakness by printing massive amounts of money. There's just one problem with that approach, and that's that the Chinese yuan has been collapsing in value too. If the People's Bank of China responded by printing money, then it would cause the yuan to collapse even further. Historically, this would make China more investable since it would become cheaper to manufacture goods. In today's world, however, geopolitical tensions have limited this kind of investment. And to make things worse, the yuan is sitting at a critical level, around 14 US cents. As you can hopefully see, this is its lowest value in almost 15 years. If it breaks below this level, it could quickly lose another 10 to 20% of its value. This would cause chaos in China and issues for the CCP. That's why the People's Bank of China, or PBOC, made the drastic move of appointing Pan Gongsheng as its leader earlier this month. To put things into perspective, the PBOC had reappointed its 2 top governors in March this year. Replacing them both with Pan makes sense once you understand just how powerful this guy is. As explained by macro analyst Weston Nakamura, Pan had been deputy governor of the PBOC for over a decade. He actually helped China's 2 largest banks go public, that is, list their stock on exchanges. Take a second to consider that 4 of the 5 largest banks in the world are Chinese. Pan did the IPOs for 2 of them. Pan has also been the director of China's State Administration of Foreign Exchange, or SAFE, since 2016, the government arm in charge of China's forex reserves. As director of SAFE, he's overseen the imposition of China's strictest capital controls and the aforementioned crackdown on Chinese real estate. And last but not least, Pan is also the head of China's leading group of Internet financial risks and remediation. As the head of this organization, he has overseen the crackdown on both crypto and tech companies in the country. He was the man behind the first crypto crackdown in China back in 2017. Put simply, Pan is the Michael Barr of China. And if you don't understand the reference, I'll leave a link to our video about Michael in the description. Now, unlike the low-profile personalities behind the crypto crackdowns in many other countries, Pan has been visibly outspoken about his intentions. The quote about Bitcoin in the intro is just one of many examples. Here's another quote from Pan about traders shorting the yuan in 2018. Quote, "In recent years, the PBOC and SAFE have accumulated rich experience and policy tools in dealing with exchange rate and foreign exchange market fluctuations. We have crossed paths with those who attempt to short the yuan a few years ago, and we are familiar with each other. I believe our memories are still fresh." Translation: if you try to short the Chinese yuan, I will pump it and you will get wrecked. Now, before you get too intimidated, Weston pointed out that Pan's posturing is exactly that. He's talking the talk in the hopes he doesn't have to walk the walk. This is part and parcel of China's so-called paper tiger diplomacy. Even so, Pan clearly has a history of walking the walk when it comes to crypto. The caveat there is that Pan isn't anti-crypto per se. As Weston also explained, Pan is only anti-crypto because he's anti-anything that could result in capital flight. He's against anything that would allow Chinese citizens to get their money out of the yuan in the event of, say, a 10 to 20% crash in its value. Obviously, Pan also has a history of walking the walk when it comes to protecting the yuan, hence why he now holds both of the PBOC's top positions. Believe it or not, but Pan's defense of the yuan could do serious damage to the stock market. I'll explain why in a moment. First, we need to talk about crypto. As I mentioned a few moments ago, Pan is only anti-crypto because it facilitates capital flight out of China, which is what Pan wants, or rather needs to stop, as part of his mission to protect the yuan. Given that the yuan is currently weak, this means there's a high likelihood that Pan will take a swing at crypto. The good news, kind of, is that Pan has already pummeled the crypto industry in mainland China, so there isn't much more damage he can do there. The bad news, kind of, is that Hong Kong has recently been embracing crypto, and since it's basically a part of China, this means it could soon reject crypto instead. This would be unprecedented and yet entirely predictable. If you watched our video about Hong Kong's crypto adoption, you'll know that it only began in October last year. You'll recall this is when Chinese stocks were starting to rally. It's also when the Chinese yuan was starting to recover from a recent low. Now, this is significant because it suggests that Hong Kong's and China's crypto adoption could ultimately be dependent on the strength of the Chinese yuan. If the yuan is strong, crypto's safe to adopt because it won't result in much capital flight. But if the yuan is weak, capital flight becomes crypto's primary use case. Here's where things get interesting. Tether's USDT is reportedly a popular tool for wealthy Chinese citizens looking to move their money in and out of the mainland. According to Protos, one of Tether's blog posts actually cited, quote, evading capital controls as one of USDT's primary use cases. A now deleted sentence you'll be shocked to hear. The only question is how much USDT is being used for this. Well, we may have found an answer in our video about stablecoin market caps. Tether CTO Paolo Arduino mentioned that around 40% of the demand for USDT was, quote, offshore dollar holdings. Some percentage of this is probably related to capital flight. Here's where things get concerning. Tether and its sister companies are reportedly based in Hong Kong. If Tether has any significant operations in Hong Kong, this puts USDT within arm's reach of CCP agents like Pan who want to knock it out. Again, this assumes Tether has significant operations there. If they do, the CCP will know about them. That's because one of Tether's largest shareholders is, or rather was, Zhao Dong, a Chinese citizen who helped Tether launch its yuan stablecoin. Zhao was arrested for money laundering in May 2021, so the Chinese authorities have him. If he knows anything, they know it too. Put simply, Zhao could be the Sam Bankman-Fried of China. And if you want to explore that rabbit hole, I'll leave a link to our video about FTX's secret bank in the description. Now, even if Tether's operations are beyond the reach of the CCP, Tron's operations are certainly not. For context, more than half of the USDT in circulation is on the Tron blockchain, and Tron has very close connections to China. These myriad connections are mostly outside the scope of this video, but I'll give you one. Tron founder Justin Sun recently bought the Huobi cryptocurrency exchange from its founder, Leon Li. According to Bloomberg, Leon has close ties to China's central bank, and according to Decrypt, the CCP runs, quote, regulatory nodes on the Huobi chain. Again, this is just the tip of the iceberg. In sum, there's a risk that the PBOC could crack down on crypto under its new leadership. Hong Kong's recent crypto adoption means that Tether, Tron, or both are possibly within Pan's reach. If he hits either of these entities, the crypto market could be in a lot of trouble, but he probably won't unless the yuan weakens further. Still, the fact that the PBOC issued a $1 billion fine to Alibaba just a few days after Pan took up his post doesn't inspire much confidence in crypto's supposed safety. For reference, Alibaba was fined for money laundering violations, something the PBOC could easily apply to any crypto project or company. But let's suppose that Pan manages to pump the yuan. Now, there's only two ways he can do this. The first is by raising interest rates. This would only crash the Chinese economy even more, so that's off the table. The second way is by selling PBOC reserves to buy Chinese yuan. This is where the macro comes in. For those unfamiliar, central banks around the world hold large amounts of reserves consisting of multiple assets, mostly US government debt, aka US bonds. This is because US bonds earn a yield and are very liquid, meaning they can be bought and sold in large quantities without impacting the price. Depending on your source, the PBOC holds anywhere between $800 billion and $1 trillion of US bonds, making it the second largest holder of US government debt outside of the US, the first being Japan. In practical terms, this means the PBOC has up to $1 trillion it can use to support the yuan. This is done by selling US bonds for US dollars and then using those US dollars to buy yuan. This is what's meant by a currency intervention, and it's exactly what China did late last month. There's just one problem, and that's that if the PBOC sells too many US bonds, it could cause their prices to drop. Given that US bonds are the highest quality collateral for loans in the financial system, a big drop in US bond prices could cause serious market instability. Not only that, but selling US bonds also causes interest rates on those bonds to rise. Now, if you watched our video about the debt ceiling deal, you'll know that the US government has been selling US bonds to refill its bank account at the Fed. Logically, this is also creating sell pressure for US bonds. That's why the Treasury has been focused on selling short-term US bonds called bills. This is in part because the demand for US bills is higher than for US bonds, and in part because too much selling of US bonds would cause issues for US banks. FYI, commercial banks hold lots of US bonds on their balance sheets too. It's the losses on their US bond holdings that have caused the recent banking crisis. That's why it's fascinating that Treasury Secretary Janet Yellen recently flew to China. It's believed that this was purely for geopolitical reasons, which was probably the case. At the same time, though, it's possible, if not likely, that the topic of the PBOC selling US bonds came up when she met with Pan. After all, if Pan walks the walk on defending the yuan this time around, it could cause a round 2 of the banking crisis in the US, plus serious volatility in stocks and other assets. Chances are that Janet offered to lend the PBOC US dollars, which it can then use to buy yuan via the Federal Reserve's swap lines. Judging by the headlines following Janet's visit, however, it didn't go too well. This suggests that if Janet did give an offer along these lines, the PBOC didn't accept it. That's because this offer likely came with lots of conditions that the PBOC didn't like. If this is indeed the case, then it sets the stage for geopolitical conflict. Which naturally brings me to the geopolitical component of the PBOC's change in leader. I'll start by saying that geopolitics is above the pay grade of the entire Coin Bureau team, so consider this to be pure speculation on our part. That said, there seems to be a race to the bottom between China and the US on trade restrictions. For example, the US recently announced that it was considering extending restrictions on AI chip exports to China. China retaliated by restricting the export of rare earth minerals used to make AI chips to the US. The US followed suit by announcing that it was considering banning China from accessing US cloud computing services. From our perspective, US restrictions on trade and investment in China are going to intensify in the coming months, in large part due to the disagreement about the PBOC's approach to protecting the yuan. That's because of the practical effect that these moves could have on the economies of both countries. China selling lots of US bonds could create problems for the US economy, and the US restricting trade and investment in China could create problems for the Chinese economy. In principle, China has the upper hand because its trade restrictions could do just as much or more damage to the US economy. In practice, though, this would truly be a race to the bottom for both countries because their economies are fundamentally intertwined. If the US economy suffers, the Chinese economy will suffer, and vice versa. It seems the real question is which economy can suffer enough to win before there's a full-scale revolution. Well, the answer really depends on your perspective. On the one hand, the US is more politically divided than it has ever been, and additional economic hardship will only worsen this. On the other hand, the US government has the power to print US dollars that it can use to buy whatever it wants. It's a similar situation with China. On the one hand, China is inherently unstable due to its centralized authoritarianism, and its closest allies are more unstable countries, namely Russia. On the other hand, Russia's resources and China's productive capacity means they can make anything that money can buy. Never mind that China has also taken over large parts of Africa. More about that in the description. Now, as far as we can tell, there are two possible outcomes to this emerging geopolitical conflict. The first is that the multipolar world that's starting to form comes to fruition, with China, Russia, and their allies in the global south separating economically from the US, EU, and their allies in the global north. Given how connected the global economy is, a full separation is arguably impossible. This means that countries will constantly be stuck between deciding which of the two they need more: the US dollars to buy commodities or the actual commodities themselves. In this case, the decision depends on position. Countries that have their own commodities or are close to countries who have them will be the first to get off the US dollar. Countries that don't have their own commodities or aren't close to countries who have them will likely stick to the US dollar for as long as they can. That is, until it goes to zero, like all fiat. Now, the consequences of this dynamic are likely to be kinetic, which we're already starting to see. As you might have guessed, that's the second possible outcome to this geopolitical instability. Not a world war, but many conflicts in different regions, namely regions where US dollar countries border commodity countries. The elephant in the room, of course, is China and Taiwan, and you can use the link below to find out why a flare-up there could be imminent. What a time to be alive. And that's all for today's video, folks. If you learned something new, let me know by smashing that like button. If you want to keep learning, subscribe to the channel and ping that notification bell. If you want to help others learn, share this video. If there's something you need to impart, drop a comment. And if you happen to hold crypto and are looking for a safe place to keep it or a cheap way to trade it, head on over to the Coin Bureau Deals page. It's got the biggest discounts on the best hardware wallets and up to $40,000 of bonuses and airdrops on the best crypto exchanges. Link is in the description. Thank you all for watching, and I'll see you next time. My name is Guy, and this is Goodbye.